He promised me that he would never stab me in the back, that he would only stab me right in the chest. And I love that about the guy.
The Phil Bach Podcast. Investing, economics, entrepreneurship.
Welcome back to the Phil Bach Podcast. Over the next couple months, I'm going to be bringing back several of my favorite episodes from my previous podcast, the ETF Experience, onto this feed. And I'm proud to bring you this episode with Dan McCabe. Dan is best known for his company Precidian Investments and their IP pertaining to non-disclosed, actively managed ETFs, which have come to market recently after years of work from Dan and his team. But even without non-disclosed ETFs, Dan has had a career, and that's in all caps. He has had a career that I envy and that, to an extent, I'm modeling my own after. He's been a trader and an innovator in the capital markets for a long time, and I really enjoyed his perspective on the podcast. So I'm proud to bring it back for my new show.
This is the ETF Experience Podcast, brought to you by Exponential ETFs. We'll take you behind the scenes of the asset management industry and talk to the innovators who are changing the way investors trade, invest, and build better portfolios. Here's your host, Phil Bach.
Welcome to the ETF Experience Podcast. We are back in New York City, and we have a great show for today. I'm here with Dan McCabe. Dan is a trader, a product developer, the CEO of Precidian Investments, which offers solutions for active managers that are looking to utilize the benefits of the ETFs without disclosing daily holdings. We're going to talk about trading. We're going to talk about product development. We're going to talk about the regulatory environment, and we're going to talk about what the potential is for non-transparent active ETFs. Dan, thank you for joining the show.
Hey, Phil, thank you very much for having me. I appreciate it.
So you have an incredible career, a really fascinating career, and we were kind of joking before, almost like the Forrest Gump of finance, where wherever the puck has been going, whatever the hot thing is, you've been in the background trying to innovate and building really cool stuff. And we're going to have a detailed conversation about active shares and everything going on there and some of the other initiatives that you have at Precidian. But I really want to take our audience back through your career and starting with coming in and coming up and getting to Bear Hunter, where you were the longtime CEO of a trading floor on the Amex and other exchanges as well. But getting into that position in the first place, tell me about your earliest days.
Well, we got to go back a little bit of a ways there, but it's funny. I remember when I started in this industry, I would have been about 21 years old. And my first interview was with a gentleman by the name of Kevin Haggerty. And Kevin was a Marine. He was a captain in the Marines in Vietnam. He was a very large, intense individual. And I was a young 21-year-old who went down to 180 Maiden Lane, and I met him for an interview. I had the Wall Street Journal tucked under my arm, went and I sat down, and I really wanted the opportunity, and I just stared at him through the whole meeting. I left there. I walked into a restroom. I looked up, and I realized I had the ink from the paper all over my face, and I figured I had blown that interview. As it turned out, what Kevin liked about me is he thought I had the eyes of a killer because I was staring at him the whole time, so he gave me an opportunity. And frankly, I've been blessed throughout my career with having some really great mentors and having the experience of learning from the ground up. So I started at the very lowest level there, and I worked my way up. Obviously got my licenses, got on desk, and began trading and then covering options accounts and worked through the crash of 87 and that debacle and continued on. From there, I went over to Merrill Lynch Professional, and I went to the New York Stock Exchange as a clerk for a specialist, a back-end clerk, sitting inside a booth, 5,000 people on the floor, standing 8-9 hours a day within, a 2.5-foot space. But again, it was a mentorship. I learned a lot about the business, hands-on, on a daily basis.
So you became CEO of Bear Hunter, and really at one time, one of the largest market-making firms on the street. Looking back to what market making was now versus what market making is today, it's really, they're both called market making, but they're completely different jobs, completely different businesses. What do you see as the biggest difference between how it was when you were at Bear Hunter and what it looks like today?
Well, even before I went to Bear Hunter, I was at an entity called WG Trading. And the reason I mention this is because I learned a lot about program trading, specifically index arbitrage at that time, working for two gentlemen, Dennis DeCore and Vince McLaughlin. And they had left to go over to Nomura to run the index arbitrage department over there. And as I was looking to develop business, I was cold calling people and showing them different ideas. And I cold called John Mulherin, who was the senior managing partner at Bear Wagner. He liked the ideas that I was showing him. He traded on a few of them, and he made, I think some pretty good returns. He called me up, asked me to come in and sit and talk with him, and I ended up taking a position. And frankly, one of the reasons I took the position with him is he was so brutally honest. And he told me something in the interview that stuck with me and still does today. He promised me that he would never stab me in the back, that he would only stab me right in the chest. And I love that about the guy. He was completely direct, so you always knew where you stood. And when I went to John, I was sat next to him for a number of years. Again, great mentor, incredible individual, and he gave me opportunities. At the time, the ETF business was just coming about. We had early products, not as early as the Spider, but products like the Merrill Lynch Holder product line that you're familiar with that were just rolling out. And really, frankly, because of my history from the exchange and then index arbitrage upstairs, I knew how to make markets in these things. So I had the opportunity then to start to build out a franchise at Bear Wagner that would be a new specialist unit to just trade exchange-traded fund product.
So you were there when GLD launched. In fact, you were instrumental in the GLD launch, as were some of your partners. I think GLD was probably the first one where people saw, wow, ETFs are really price discovery or access tools. This is how the market is going to look in the future. And sure enough, it came to be. What was that like when you were working on GLD? I mean, did you have any idea how big it would get?
At Bear Wagner, I met a couple of my current partners. I met Paul Coonley, who was the CTO of Bear Wagner, and Mark Criscitello, who was our CFO. And collectively, we had worked on a lot of things, but GLD came along because the CEO of the World Gold Council came in and interviewed us to see who he wanted as their specialist. And he and John Mulhern got along very well. He chose us to be that specialist. And then I met, again, one of my current partners, Stuart Thomas, who was tasked by the World Gold Council to help develop what was the first commodity-backed product in the United States. And frankly, the four of us worked collectively for about 3 years to get that through the SEC. And there was a lot of give and take. Frankly, I remember days one day specifically, where the SEC said, this is never going to see the light of day, just go away. And we had to marshal the troops and get a bunch of attorneys together and get down and go sit with the commissioners to talk to them about why this was important. To your point, it is a wrapper. It's a vehicle that actually is a very efficient vehicle. It's given tremendous advantages to the investment community to be able to access gold in that manner.
So your skill set here to date, I mean, we're still early in your career, but we're talking about program trading and Delta One ARB and also dealing with the regulatory and the product development side would obviously come very much into play in the years to come. And that'll lead nicely into everything you've been doing at Precidian. But before we get there, I think it's also important to talk about some of the initiatives that you did while at Bear, like the closing cross, and the impact that had on the overall markets and the ETF ecosystem.
Yeah, it's one of the things I think looking back across my career that I'm frankly most proud of, in that there were a lot of difficulties back in the early days of trading, program trading, trying to access the closing value of a NASDAQ security. And because we were running into a lot of impediments there, I worked with a gentleman by the name of Brett Redfern at the American Stock Exchange, and collectively we approached Standard & Poor's, and we got David Blitzer and Bob Shikotko at Standard & Poor's to work with us to change the closing valuation price of the S&P 500 index, which at the time was $1 trillion index, away from NASDAQ as a closing price and to move it to closing prices on the American Stock Exchange, because the American Stock Exchange had a natural closing cross where everybody could access one price. Well, that forced the NASDAQ to come up with their mechanism of closing cross mechanism, which now everybody utilizes, and actually has made trading indexes and ETFs by extension a lot more feasible.
Tell me about starting Precidian and what was, of course, it was Next Investments at the time.
Yeah, well.
There was another name, right?
We had M7.
M7, right?
And we still have M7 Ventures is still alive. But the reason that we started, I think, Precidian was sadly one of the men that I had mentioned, John Mulhern, had passed, I think, in December of 2003. And we noticed the business was changing, right? I mean, we had so many things coming at us. Reg NMS was coming at the specialist system very quickly. And I was looking around, and I had developed very strong relationships with some of my partners. And we felt that we would be better off betting on ourselves rather than leaving it up to other people to dictate our destiny. So we wanted to get out ahead of this. And really, we knew what we were very good at. And my partner, Mark, always makes the point. The reason we became very good at structuring product is that we were risking our own money. So when you were off or something didn't work, it was our own dollars going out the back door. And that's one of the reasons that Wall Street, from when I started, one of the big changes from when I started to where it is today, there were a lot more partnerships. And there's really no better oversight than having a partner watching over his own capital.
You and I met probably about 12, 13, maybe even more years ago. I mean, I'm thinking about it now. It must have been about 06 or 07. I was at Ridex Investments, and I was a product manager on a bunch of our ETFs, a couple mutual funds, including the currency shares lineup, which is this kind of very well-known and very unknown at the same time, this like odd product group in the industry. And of course, it's a joint venture at the time between Ridex and what's now Precidian. Now it's with Guggenheim or Invesco.
Now it's with Invesco. It did go to Guggenheim, and then Guggenheim sold it to Invesco.
Years later, we ended up working together again on currency shares when I was at the New York Stock Exchange, and you had a proposal to address what's called phantom shorts. And this is just such a fascinating solution to such an unknown problem. And let's kind of set the table on this with, tell us what currency shares is, and then tell us about what phantom shorts is and why that's a problem. And then we'll talk about that process that you initiated to try to solve it and how that ended up.
Well, I want to back up to what currency shares is, as you said first. And pretty much currency shares use a very similar structure to what GLD utilizes. And we had known that structure is a 33 Act fund, but what it was really useful for is a wrapper around a commodity or currency in this case. But currency shares is a on-demand deposit account on the books of JP Morgan where you can access, as an example, euro or Japanese yen on an individual basis. And they trade on exchange just like any security would, and they have very, very liquid option markets behind them. To your point, one of the things that we recognize with currency shares, but really more broadly across a lot of passive ETF product in the marketplace, is tremendous amount of short interest. And as we were looking at that, we recognized that what was causing some of that short interest, it's not in an ETF, there is no need to maintain a short. If you choose to maintain a short, you're doing it because you want that exposure, specific exposure. So shorts are not necessary for making a market in ETF because you can always create to go flat. The reason some people remain short an ETF is because there is a natural decay of the management fee in the ETF value or the ETF's price. So you have the ability in an ETF to go out and borrow shares and either go to the fund and redeem, sit long the underlying component securities, and pick up the management fee through the decay of the ETF if the valuation of the loan is not pricing in the cost of the management fee.
In other words, the expense ratio on the currency shares, let's say it's 40 basis points, you'll get that exposure if it's euro against USD or yen against sterling, whatever it is, minus the 40 basis point expense ratio drag. So if you can borrow it and short it for less, then there's a little bit of a trade there.
Correct. And what should be happening is whoever's loaning those shares should be embedding the management fee, because if they had to go out and create those shares on their own to loan them, they would embed the management fee. But what is in reality happening in some of these places is that they're taking customer shares and they're pushing them out the back. Since the customer's already agreed to pay the management fee, they're not embedding that in the loan. So our concept that you talked about that we had come to the exchange and then proposed to the SEC was a methodology whereby we would be able to embed the management fee into the security loan. And it's something we called recapture. And we're actually going to take a good portion of that money and rebate it right back to the shareholder or to the fund. And frankly, the SEC quickly shot that down. They didn't like the concept. At some point, we really want to revisit that because I think that sometimes it's very painful to be a little too far ahead of the curve. But when we did this study years ago, we were seeing over $350 million lost to the industry in management fees to what we thought were loans that should have been closed out or charged differently.
In other words, if all those shares that were being lent out, if they had been created and then lent out, then there would be an extra $350 million in revenue to the fund issuers, which then ultimately could potentially lead to
lower
better
fees.
pricing, lower fees on the ETFs themselves. And I think the SEC's concern was that, well, if we start policing the shares lending, we could impact price discovery and we could impact the ability to sell freely, to sell short.
Correct. One of the primary things that we know about the market in general is that there should be no free money. So what we were doing is actually taking something that exists today and bringing that back to par. Right now, there's a discount in a lot of these things, and we're trying to get rid of that discount by embedding the management fee into the stock loan.
Also, with regards to currency shares, you worked on something very interesting called ADR Plus. Now, one of the things that I've noticed in the industry is when you talk about hedging out the currency exposure of foreign securities, stocks, or ETFs, it seems to be a problem. It seems to be something people think about when the dollar is weak. And when the dollar is strong, nobody really cares about it because they're kind of doubling up their bet. Of course, the purpose of hedging out currency is always to hedge it out, to eliminate the risk, whether it works in your favor or against it. You're making a bet on a security. You're not making a bet on the currency as well, unless you intentionally are, and I don't think that's usually the case. ADR Plus solves some of those problems. What is ADR Plus?
Because, frankly, my partners and myself are pretty good at structuring product. People bring us a lot of ideas and they'll say, hey, look, this is something we want to do. We don't really know how to accomplish this. Can you guys work with us on this? And we actually spent a couple of years with the Bank of New York on this idea. And the Bank of New York is one of the larger ADR players in the market environment. The concept really, again, most people wouldn't recognize that an ADR comes with inherent, that I think you recognize, inherent currency exposure embedded in it. So if you're buying Toyota Motor, you're buying that Toyota Motor with yen exposure. What we were going to do is negate that, to bring it back to US dollar terms. And this took us almost 4 years with the SEC to get approved. We do have all the necessary approvals now to bring that to market. And we're very excited about the opportunity. When you look at the scale of that opportunity, we're talking about $1.4 trillion, I think, that are held in ADRs today. And the estimates that we had internally looking at that is that you could probably get somewhere about 30% conversion to people that would like to eliminate the foreign currency exposure. That won't happen overnight, but over a number of years. And basically what the product is it is a 40 Act product that holds only really, frankly, two things. One would be an ADR, and the other would be a currency overlay for the amount of ADRs that are in the fund. So we can negate that on a daily basis. We're negating that exposure.
I love it. I think it's a very simple, elegant solution. And I think, again, the fact that in your example with Toyota, the fact that people have that currency exposure seems to be only something they concern themselves with when the trade is moving against them, and that it really shouldn't be that way. As an aside, I started my career in the FX markets, and the FX markets is very counterintuitive, I think, to a lot of people that are just equity or fixed income traders, where it's hard for them to see that sometimes those trades work or more often than not, they really work in opposite directions, and you're really hampering your own returns by embedding that currency exposure.
Funny aside, I mean, we were down in Florida a couple of years ago, and we met with very large ADR holder, and we were talking to him about the product that we were proposing to bring forward. And he told us he didn't have any currency exposure. And he owned hundreds of millions of dollars in ADR product, and he had no idea that he had currency exposure. To me, that's a little bit frightening, but I think that there are a lot of people that are out there like that.
So let's bring this up to today. So now the biggest news in the industry is the approval of active shares and a couple other structures as well that solve the problem that asset managers have, which is I want to launch an ETF because there's some tax benefits. I can get around having my own transfer agency in-house and use the DTCC system, which is what generates most of the cost savings for the issuer side, which is typically passed through to the end investor. ETFs are not always cheaper than mutual funds, but by and large, they are more often than not. And they have some real tax advantages by being able to swap out cost basis upon creation or redemption. So you've got a better structure, but the problem is ETFs have to be priced in real time. And being priced in real time means that the market makers or anyone that might present an arbitrage trade or even a retail investor that wants to sit there and calculate in real time what the underlying securities are worth before they go out and trade wherever the secondary market is, that requires daily disclosure of what is in the ETF, be it GLD, be it a basket of currencies, be it stocks or bonds or anything else. So if I'm an active manager and I have to disclose on a daily basis, I could be worried about being front run. I could be worried about my secret sauce being reverse engineered or anything like that. So you've developed what you call the blind trust, which is really the secret ingredient inside the active shares product. What is the blind trust?
Well, I'm going to give you a little different terminology because the SEC some years ago asked us to change that from that terminology to a confidential account, which is in fact what it is. To your point, there is a massive interest in this. And just this last week, Goldman Sachs had filed to be able to launch vehicles using our product. We have 14 licensees that have about $13.5 trillion of assets under management. So the very largest firms out there are looking to bring product like this to market. The concept really was to kind of level the playing field between today's existing passive manager and the active community has really been held on a sideline since 1993, where they haven't had a vehicle to compete head-to-head. To your point, every one of the advantages that you were talking about, removing sub-TA fees, potentially reducing 12B1 fees, bringing additional tax efficiency, and letting it trade on exchange are all major advantages to an investor. Our process is, frankly, something that when we create vehicles, we want to create a process that is essentially streamlined and as simple as you can make it that works. You don't want to put too many bells and whistles on it or overcomplicate a vehicle structure. So what we are utilizing is something we're calling an AP representative to create or redeem shares on behalf of an AP, which is just ETF promise for an authorized participant, a party that has an agreement with the fund to be able to create or redeem shares.
Let me just kind of pause it right there. And I'll use Kevin Quigg has the best analogy for this process that I've seen. So you got a sneaker factory, you've got Nike, and you've got Foot Locker, and you've got the guy that buys the shoes. The trader, if you're an asset allocator and you're buying an ETF, you're the guy buying the sneakers. If you're a market maker, you're Foot Locker, and the ETF issuer would be the Nike. So in between the person buying the shoes and Nike, alongside Foot Locker, you have something called an authorized participant. They're allowed to create and redeem in blocks 50,000 share units, which is like a truckload of Nikes that can then go into Foot Locker. So they're facilitating that trade back and forth and creating the supply or collapsing the supply so that the market maker doesn't have too many shares on their books, which is a cost drag, and so that they have enough shares on their books that they can then go out and offer the shares to the investor.
Correct. And if you look at today's, which I think you began to describe was today's ETF model, and what we've done is insert this new entity in between today's AP and the fund, who will have the ability on behalf of that AP to create or redeem shares. And that confidential account is a confidential account of the AP with the AP representative. So in this case, assume the AP representative may be somebody like a Bank of New York or a State Street Global Markets, who will provide that as a service downstream to the market-making community.
The AP needs to know what's in the fund because they are the ones delivering or taking the shares. And by doing so, by using the shares and not just using the cash value of the fund, that's how they can maintain a lot of that tax advantage.
I'll say the AP doesn't need to know what's in the fund. The AP needs to have access to what is in the fund. And I think that's a really critical point to understand, because the creation and redemption can happen in kind, just like you're talking about, without his direct knowledge of what that fund manager is holding on a daily basis.
So net, at the end of the day, you have the AP who's still able to create and redeem, who's still able to create that tax advantage that ETFs have that mutual funds don't.
You're going to pick up a lot of efficiencies. So in kind on the creation side, so the fund is not being handed cash, so the fund doesn't actually have to go out and execute that cash and put that to work. Those shares have already been paid for and delivered in kind, reducing the execution cost inside the fund. On the way out, again, the fund is not raising cash at the fund level, so the fund is handing out in-kind securities, again, not having execution costs, but also not generating capital gains at the fund level. It's able to reduce the overhang of capital gains by delivering out a pro rata slice in kind into the AP representative, who then liquidates it on behalf of the AP. So to the AP, it looks as if it's cash create and redeem, but in fact, it's actually an in-kind creation and redemption process.
So that's the mechanism, but for the investor, for the end investor, they get the exposure that they want. They get the active management in the fund, but they also get the intraday liquidity. They also have, hopefully, the pricing of the fund will be reflective of the fact that there are less internal costs thanks to the transfer agency not being required. And ultimately, the ETF vehicle, which the modern investor has shown a clear preference for, can be used to facilitate active strategies that until now have been unavailable.
I couldn't agree with you more, and I think that's why we've seen so much demand for people to be able to want to be able to launch a product like this into the market environment. But the one thing I'll say from the SEC was very good with us over the last number of years, and they came to the recognition that what we're talking about here is really just an ETF. And to the end investor, to the mom and pop investor out there, or even an institutional investor, it's really going to trade subtle, clear, and function, just like the spider would, or any other ETF in the market environment. What we've touched, and very specifically, the reason we've only touched these portions of it, is that it only affects the professional trading community who are well equipped to do exactly what we're talking about.
Now, when you say the last number of years with the SEC, how many years are you talking about?
The active shares concept goes back over 12 years. When we initially came up with the concept, we knew immediately what it was good for. We actually had been sitting around just drawing up some ideas. We had a company out of California, a very large asset manager, who approached us, and they had a lot of embedded capital gains in a specific small cap fund. And they wanted to know if we could help think about ways to work out the embedded capital gains. My partners and I got together and we went to a whiteboard and we just started drawing things up. And once we came across it, we realized immediately this is how you do an actively managed ETF. And we actually flew out to California. We sat down with the guys at BGI. It's the largest table I ever saw. It must have been 40 people around it. And immediately they wanted to license it exclusively. And at the time, they were one of the big players in the ETF space. We frankly thought we were all done. We were going to be able to go home and retire to Florida. And they quickly sold themselves to BlackRock. So point is, it goes back that far. We did enter into a license agreement. We had to renegotiate that license agreement. And once we were able to renegotiate the license agreement, then everybody else wanted a piece of it. And we've been moving steadily since a decade ago.
Most of that time was spent waiting on SEC approvals. And you've got approvals that you need at the Division of Investment Management. You've got approvals that are needed at the Division of Trading and Markets. In the middle of this process, following the global financial crisis, I guess really towards the beginning of the process, but following the global financial crisis, approvals at the SEC on innovations in the financial services space became a lot harder for a long time, and probably for good reason. But there was a lot of concern at the SEC about anything that was new and novel. I think a lot of that has thankfully dissipated, although there are quite a bit of people that are trying to get a Bitcoin ETF through that have been at it for several years as well. Not 12, but still it's putting some gray hairs on some people in that industry. During that whole process, during that whole timeline, you go down to the SEC, you make a pitch, they maybe, submit a comment letter, and then you provide more information and make a pitch. But most of the time you're waiting, and a lot is out of your hands. You're waiting. There's another deadline a few months from now. You're waiting for that. That comes and you're responding. But most of it's waiting. I mean, what do you do for 12 years? You have this incredibly high upside opportunity. You have something that you've worked really hard on, that you're chomping at the bit to get it out there. And you don't know. You don't know when the start date is. You don't know what the outcome is going to be. Tell me about that. How do you personally and the rest of your team, how did you guys manage yourselves and bide your time, but also at the same time come in every day ready to try to move the ball forward and be prepared for maybe a yes for a 10, 12-year period?
I can only say that I think that if we were to start over, knowing that it was going to take us 10 or 12 years, we might have focused on something different. But we were so certain that what we were talking about here was correct and that it would work that, frankly, we weren't willing to give up on it. I want to be clear about one thing. We do have approvals from Division of Investment Management. The exchange has approvals from the Division of Trading and Markets. We are awaiting the final approval from Trading and Markets that we anticipate could, frankly, be at any time. But we're right on the cusp of this. And I think that's a very good thing for our industry. And you can see this is why so many people have been really fast followers of coming along and trying to file products, both utilizing this structure and others. To your question, how you kind of keep yourself upbeat. I've been, again, really fortunate with not only mentors that I've had in my life, but partners. And this time around, we got to choose each other as partners. So we weren't foisted upon each other. We went into it knowing these were people that we chose. And we were able to, frankly, sometimes carry each other when it got really difficult. There were really difficult, dark days that we were told, this is never going to happen. Basically, go away. I think the first time in the history of the SEC, we were actually voted down back in 2014. And frankly, the staff had not communicated with us for over a year prior to that. We just needed to keep taking steps. It was about educating the community, bringing people along with us. There were so many people that helped us during the process, and there are some of the biggest investment banks out there who came to the SEC with us and said, look, this is important, or they wrote letters on our behalf. Market makers that came and spent a lot of time down there. We had to get lobbyists just to get access to make sure that we were being heard. It's the old axiom, if you're not at the table, you're on the menu. And we had to get at the table so we could have these discussions.
I'm just going to hit you with one more question on this process because I'm just fascinated by it, and I had a front seat for most of it, and it's really something else, something that I think people out of our industry and out of this regulatory and product development process really can't fully fathom. And what I want to know, the thing I think about is that day you got the first approval, was it last year? The day you got the first approval and you realized that this might be coming, what was that celebration like? Where did you go? Did you just quietly crack open a scotch at home, or did you go out and blow it out?
Like I told you, I mean, it wasn't that. It was actually almost a reverse of that. It was kind of a letdown because it shouldn't take this long to kind of have a reasonable dialogue with people when you're trying to do something that we can classify as novel, but it was a betterment to the industry. And it was an arduous task. And, there have been kind of funny events where we thought we were going to be there and we're getting ready and we're right on the edge and then you get shot down again. And, again, you just got to pick yourself up. And I have partners that I guess all of us have a same kind of mindset that we had the ability to bounce back. That's something that you learn from being in business for a while. People aren't successful often right out of the gate. You can fail, and maybe third, fourth time you succeed. And that's, I think, what's kind of set us apart. And I can say one thing. Doing what we did here would not have happened inside of a big firm. Would not have happened because they would have cut and run years before we got approved. And also the other thing about product development, really you need to have partners that you trust, be able to be open and honest with each other, and have a pretty heated dialogues at some points to make sure you get to the right outcome. And I have that, and we have that as a team to be able to sit down and argue things out. Sometimes it gets very heated, and my partners, they're not wallflowers. They're going to come right back at you. But we have that relationship that we trust each other enough that we can argue this out and try to get to a good position. That would be something very, very difficult, I think, to do inside of a large firm today.
Completely agree. I mean, for a lot of those same reasons, I'm doing what I'm doing. For the ability to really innovate, and if you have that vision, it's not as much about convincing other stakeholders of that vision as much as it is convincing the world that you need to adopt it. And that's a much more challenging thing, but a much more productive thing as well.
It's been a lot of fun, but it's been a long road.
How big can non-transparent ETFs get?
This is where I'm supposed to say, I don't think it's going to be that. But I'll tell you, I actually think we underestimated initially what the potentials are. I think actually over the next 5 to 7 years, there's going to be well north of $1 trillion in these vehicles. What you have to recognize is that the education to the client has already been done. The client already knows what ETFs are. They're familiar with passive ETFs, they're familiar with bond ETFs, foreign securities, they're familiar with commodity ETFs. This is just another extension of that. And to the end investor, it looks the same. And there's a big desire for that. So the partners that we're talking to, some of the biggest asset managers in the world, they have tremendous teams already in place with really high quality people who can educate downstream their customers the value of this. And I think it was Ken Worthington at JP Morgan had done a study 6 months ago. And, I think he estimated that in 5 years, you could see 50% of the available assets that are covered by our approval notice to move into the ETF realm. Those are really phenomenally big numbers.
It's unbelievable. The fact that you've had to struggle for it, the fact that it's out now and that it's coming is very exciting. It's been a long time since we've had big innovation in the asset management industry. So it's fun to see it on the cusp. I always ask my guests a closing question. Tell me an obstacle that you've overcome or persisted through, either in your personal life or your career. This whole story was an obstacle that you've persisted through. So, but I'll give you the opportunity to come up with another.
I've been blessed in a lot of ways. I have a great family life, great wife, a bunch of kids. Everybody's happy and healthy. The hardest thing for us, I think, about this was just, to your point, the daily grind. You have to get up every day and you have to say, this is something we're working towards. And again, there were times that we thought were right on the cusp and then it would be gone for another year or two. And there were times when people didn't communicate for well over a year. It is very, very difficult. But again, I think that's kind of changed. Really fortunate. To your point, I have to give accolades to the chairman of the SEC who came in, really did a great service to all of us in that here's a gentleman who took a major discount from what he was making in his previous roles, came in and did a service and really brought in a lot of new people into different positions on the staff who are also a lot of times probably underpaid for what they're doing. But it has freed up, to your point, innovation, which I think at the end of the day is going to be very beneficial. And they've moved our industry along. And it was kind of frozen, maybe for good reason after 2008. You frozen for a little bit of time. But I think we're in a pretty good spot now, and they should be commended for that.
Well, congratulations to you and your team on getting this far, and wish you the best of luck with everything to come. I'm sure 2020 is going to be a pretty big year. If someone is listening, if they want to license your IP or learn more about launching a non-transparent ETF, how would they contact you?
Yeah, I think the simplest thing, you should probably educate yourself a little bit. You can go to activeshares.com. There's plenty of information there for you, either from a sales perspective or from a licensing perspective. And then feel free to reach out, give us a call. The numbers are right there. We're talking to a lot of people. And really, we want to see the industry adopt this. And to your point, when you have the likes of clients like a JP Morgan or a BlackRock or a Capital, or you go down a long list, if we can get the industry momentum behind the initiative, everybody's talking about their specific expertise and not necessarily about the product. The product should be behind the scenes. And I think that's where we are today, and that's exactly where I want it.
Completely agree with that. Of course, Exponential can help you with the trading in the capital markets if you're looking to launch an ETF and you need help in those areas. Dan, thanks again for coming in. Thank you to our listener for your time and attention. Please like, rate, share the show if you're so inclined, and we'll be back next week.
Thanks for joining us this week on the ETF Experience Podcast. Be sure to visit us at exponentialetfs.com to join the conversation and view our show notes. If you love this episode of the ETF Experience, head over to Apple Podcasts to subscribe, rate, and to leave a review. As always, thanks for listening, and see you next week.
This Exponential Exceptional podcast is published and provided for informational and entertainment purposes only. All opinions expressed by the show participants are solely their current opinions and do not reflect the opinions of Exponential ETFs. None of the information constitutes a recommendation that any particular security, portfolio of securities, transaction, or investment strategy is suitable for any specific person.
Gold Shares, ticker GLD, is part of the Spider family of exchange-traded funds managed and marketed by State Street Global Advisors. An American Depository Receipts or an ADR Plus stock is a foreign stock that allows U.S. investors to trade its shares on the U.S. exchange.